IVM.
There's a quick survey to fill out on ivmpodcast.com/survey. It lets us know a little bit more about who's listening to us. And you know what? We're going to do a few prizes. So, we'll do a random drawing of maybe 10 people and we'll send you all some swag. Remember, that's ivmpodcast.com/survey where you can fill out the survey.
Hey everyone, welcome to episode 179 of Shunya One. We're talking to the two co-founders, Upside.ai today, 2 out of 3 co-founders. Kanika Agarrwal and Atanuu Agarrwal join us for a very interesting conversation about what makes Upside AI very, very interesting. And this is a company in the investment financial market space, which uses AI as a technology layer to actually help their customers and clients get interesting returns. And I had a very, very enlightening chat about exactly what AI is in their business and how they've really sort of capitalized it in a very unique way. So if you're interested in anything to do with finance and investing, I think you'll find this very, very interesting. So let's take a break, come back and talk to both of them.
Habits? Routines? How exactly do they help us get better? Well, to simplify it for you, tune in to the Habit Coach podcast. I am Ashton Doctor and I'm going to be here to help you get better daily with some simple, easy to do habits that you can easily adapt to your life. So tune in to the Habit Coach podcast from Monday to Friday because I believe that awesome lives start with awesome habits.
Hi, welcome to Shunya One, Kanika and Atanuu. How are you guys doing today?
All good. Excited to talk to you and answer all the different questions we've been talking about.
Same here. Very excited to be here. Thank you for having me.
No, most welcome. Thank you for making the time. You guys are obviously also based in Bombay, of course, given the kind of company that you are at the financial center of things. But, also this is not your first podcast, is what I understand. Kanika, I think you've already been on a show on IVM.
Yeah. I'm a repeat guest. I was just so interesting. I had to come back, right? I did one with Anupam last year. And excited to talk to you again. IVM is a great platform. Yeah.
Awesome. Though that's great. And like I was saying earlier, I know Paisa audience is obviously a lot more financially savvy, but here at Shunya One, I think all our listeners are equally tech savvy. So today we're going to probably talk about more of the AI part of Upside AI and how all of it sort of unravels. But before we get into that, I always like to ask, personally for both of you, how did this journey actually come, to bear? As a personal background, how did both of you get the entrepreneurial bug to sort of build this? And if you could give us a little bit of backstory.
So my background has largely been in finance and investing my whole career. I'm a CA, CFA by training, started out at EY, then Credit Suisse investment banking. And then I was with Mayfield, which is a venture capital fund doing early stage investing. So consumer internet and SaaS were my main areas of focus. But you always knew I was going to do something on my own. I'm half Madhu, half Gujju. So what else am I going to do but business, right? You're eventually going to do it. So just quit, 4 years into VC. Opportunity cost keeps going up. So it's better to leave sooner rather than later. Didn't know what I was going to do yet, but met these guys at Credit Suisse. We'd been friends for a while and then ended up starting Upside together.
Yeah, wonderful. With me, it's similar in the sense that I've also spent my entire career in investing. I graduated from IIT Bombay in 2011. IIT Bombay is where I met Nikhil. In fact, Nikhil and I studied for IIT JEE together since we're both 15 years old. So Nikhil is our third co-founder, is a very, very close, very old friend. And we happened to go to IIT Bombay together. We were in the same hostel together. And then after IIT Bombay, I was in Credit Suisse in the investment banking team, which is where I met Kanika. Nikhil also coincidentally was in the algo trading team. Not that we're tied at the hip, but these things just happen.
Of course.
And then after Credit Suisse, I was in New York for 6-7 years, working for a multi-strategy fund out of there. And I was doing, public markets, private markets, US, Europe, India, managing about $1 billion along with the founder CEO of the fund. So it was the two of us in New York managing the capital. And that's, so sort of my ambition was slightly different than Kanika's in the sense that I always wanted to have a fund of my own. Right, I wanted to have and manage a pool of capital and sort of do that for a long period of time. I've been a disciple of Benjamin Graham and of course Buffett to some extent after that for a long period of time, and that's what I wanted to make my career in. And I think that's where sort of our paths met, where we decided to start a startup which is in the investing space or the fund management space. Right? So that's my journey.
And how AI really comes in is Nikhil. Nikhil, again, IIT Bombay, computer science, BTech, Credit Suisse on their algo desk. And then he went back to IIT Bombay and did his PhD in machine learning. So he is the AI part of Upside AI, where he actually wrote every single line of code is written in-house. He's actually written it. There's nothing off the shelf we use. So Atanuu actually designed all of the products, and then they were all sort of coded by Nikhil, and then that's how.
Of course, yeah. My next question was going to be, both of you are definitely the upside, so someone else is adding to the AI, but.
Correct. And that's how it is with starting up, right? A lot of it is, so much of it is serendipity, because you meet each other at the right time. Nikhil was finishing up his PhD, figuring out what do you want to do. I just quit. He loved investing. So it all, everyone's skills were complementary enough for it to take off.
And this was some time back. I think you've guys founded in like 2017. And since then have been building, this product up. I'd love to ask why the focus on, let's say, the AI aspect of it, or what exactly is the product? If you could go into a little detail of what the vision was when you formed the product itself.
Yeah, I'll take this. So I think the idea was born out of my experience in the US, right? And when you sit out of there, you realize how much of the investing world has moved away from human-driven investing, right? Most of the trading activity in the US is system-driven or rules-driven. The biggest hedge funds in the world are quant funds. The most successful investor of all time is a quant fund, right? And I think to some extent, as with most things, India lags behind the US. And there is, not to say that there isn't tech investing in India, but it's mainly on the technical side. Someone doing high-frequency stuff or arbitrage stuff. No one's really using tech at scale here. And by at scale, I mean using fundamentals where you use company fundamentals and invest, not just trade. Right, that's still the domain of humans in India. Right, there are star fund managers, which all of us know. There are mutual funds, which are all run by humans, and there are small AUM, which is there in passive ETFs. But there is nothing really at scale where someone is using technology, using a system-driven approach, and applying that to investing, and is a scale AMC. Right, so that's our vision, that we want to be India's first tech-led AMC, and at some point in our journey, get a mutual fund license and offer these products to investors, where the fund manager is not me or Kanika or Nikhil, it's the technology, it's an algorithm, right? So that's the vision really, to build India's first tech-led AMC.
So I have a fundamental question around what you just mentioned, why India today still is a little more manual-driven market. Is there anything to do with what you are allowed to do as a financial institution? Is there any regulatory limitation on the fact that there needs to be a person managing a fund who is certified to manage a fund and is, and so on and so forth, and it can't be just a machine in the cloud?
Yeah, I mean, see, those things are true for us as well, right? We are the ones who have gotten the license. We are managing the fund. It's not like the algorithm is directly trading in the market. That's not what's happening. It's the process that goes into building the portfolio. What happens today is, most of the time, is there's a human being who has some intuition or some, basic rules that they go by, and they filter a bunch of securities, and then they go meet management, and then they form a view on that security and recommend either include in their portfolio or not, right? That's usually what the process is. So our process is just different from that where the screening and the evaluation is done by a machine. And then, of course, we, the final portfolio, we do a sanity check, we make sure the numbers are all right, and then we execute the portfolio. So there is still a human being who's managing the fund and who's the face of the fund, but the process is different. Right, we are relying on technology to pick the portfolio, while most people rely on their own intuition or whatever you want to call it, right? Their own sort of intellect to pick the portfolio, and we think that technology over time will do a better job than any human being.
And since you are formed, again, obviously it's been a very interesting time in the Indian financial markets, I would say, over the past especially couple of years. So how have you evolved your product thesis or the components that you use to actually build the intelligence layer of your product? Could you talk a little bit about how you've evolved?
So, we started in 2018 and spent a year actually in beta, just testing out or tweaking things, right? Learning from the market. So you have back tests which tell you one thing, and then live markets are very different. You need to understand whether your parameters work, what doesn't, what your impact costs, blah, blah, blah. So made lots of changes and then went live in 2019, mid 2019. Super interesting. 6 months into it, we're sitting, 2020 comes, and biggest learning, honestly, for us was do not veer from the system. If the system says do something, that's what you need to do. The whole idea of why we did this is to get away from human bias and emotion. As soon as I need to time the market in March 2020, I've defeated the whole purpose of why I built this. Right. So, and at that point, we were very small. I think we had 2-3 crores of AUM. Markets are falling every day. You don't know where the bottom is. You run the system, and the system is actually sitting in stocks. It's buying, positions and saying, listen, there is no cash positions we're taking. And at that point, we said, listen, that's what the system says. Sure, I don't know if this is entering nuclear winter, but you got to buy. We bought. We all know what happened over the next 2 years. So obviously that worked out great for us, but it could not have. In many ways, things could go on many different ways. But answer remains the same, which is if you build a system, you have to trust it, move away from human bias, emotion, judgment, and that's really what it's supposed to do. Sometimes it works for us, sometimes it doesn't. It's not like it always pays off, but idea is over long periods of time, consistently using a framework is better than not, is the bet we're making.
Okay. And,
so it did a lot of evolving early on. And then after that, it's a lot of, either course correction or fixing, making it more efficient, making it faster, making it leaner, things like that. But the core algorithm hasn't changed much over the last 2 or 3 years. It just gets, it gets smart as it learns more things.
In continuation to what you were saying about how, the thesis on which your model is built, it's all proprietary. How do you make sure that, it isn't doing anything strange? You've mentioned, of course, that you have, you have your own overview on things, but how do you keep it from, let's say, deviating going from too much? Yes, the AI going rogue, as everyone fears one day will happen.
Right. So there's, lots. I think that's the one thing that we are the most paranoid about, which is you built this, it's telling you that it's going to do this X return, but is it actually going to do it? Right? And how do you test that? So there's a whole bunch of tools that we employed right at the beginning also to make sure that there is no overfitting or underfitting. So when we say we're doing 50 million portfolio iterations, why isn't it 5 billion? Or why isn't it just 500? Right? How do you come up with this number? So what you're doing is when you're running these iterations, trying to make sure that it is learning, but it is not over-learning.
You're not brute forcing it. You're not trying to force the algo to come up with something that is just a coincidence, something that doesn't actually exist.
Yeah. Right. Yeah, correct. So we do that. The other thing we do right at the beginning is we said, okay, it's dynamic. It learns any market. What if I just throw in S&P 500 data, just throw in US data? It should learn any market, right? It should be able to deliver returns. Learn that market and deliver. Sure. And it was able to do that. And that was actually a genesis for our US product, right? Which is trying to do a completely out of sample test. That's what it's called.
Nice.
Couple of the kind of test we'll do is randomized prices. So what we're saying is our whole thesis going in is fundamentals drive value and market prices move with fundamentals. But now what if all prices are random and there is no connection to fundamentals and prices? Will it still be able to find good returns? And what we found is it wasn't able to. There's no connection. It doesn't know what to learn, right? So there's a whole bunch of different kinds of tests like this we keep doing. And same thing when you're deciding to add a parameter, it has to have a statistically significant impact on your numbers. It can't just be throw everything at the wall, right? So anything else? What else do we do?
No, I think you covered a lot of it. I mean, it's basically making sure that you're doing something that's
actually
replicable. Yeah, replicable in the real world, right? You're not creating something which is fleeting and will disappear in some time when you actually go to implement. So I think that's the end objective.
No,
Correct.
very,
So
very.
these techniques are constant and consistent. Every time we build a product, that's our main source of paranoia, which is, have we actually built something of value, or is it spurious?
And is the spread of what you, so again, just for everyone else who's trying to understand what the actual outcome that you provide. So you provide for your customers and your users. Is it it's a fund management product where people can, let's say contribute the funds they want you to manage on their behalf, and then you go and implement it. It's like any other fund management product out there in the market. Only thing, the decisions are assisted with technology.
Yeah. Actually, why don't I at least we've talked about the approach, etc. But so at Upside AI, what we're trying to do, like we said, is manage money smarter. What we're doing with that is offering products across different market, different ticket sizes. And idea really is to democratize this. So we started with a PMS, where a portfolio management service, where you have to invest minimum 50 lakhs. That's the SEBI regulation around how much goes in. And then we manage that money. So you give us the money, we decide what to buy, what not to buy, when to sell, etc. And then we run that for you. And very recently, and Atanuu heads the research part of it, where we launched our research products, which are available for retail. Where what we're trying to do really is allow people access to the technology. It doesn't have to be only when you have 50 lakhs that you can access good tech. Right. So now you can invest as little as a lakh using our research to buy a bunch of stocks. So we're available on small case and different products available on that as well. But like you said, yes, it's an investment management using machine learning.
And maybe to Atanuu, so the retail products, which is, like you said, small case, those are also basically nothing but an abstraction of the same intelligence from the markets. It's just packaged differently for retail investors.
Yeah, absolutely. So basically the way that we slice the products is, one, you can view it by the ticket size, which is one angle, and the other angle is a different risk return profile, right? So I think while our core algorithms remain the same at the back end, right? We have about 2 or 3 core algorithms that we use for our products, a combination of them. The products on the PMS side and on the small case side, they are different risk return profiles, right? So for example, on the PMS side, we have a flexi cap product, which is very heavily invested in small caps a lot of the time. Right? It has freedom to do whatever it wants to do, but generally speaking, on average, it is heavily invested in small caps. Right now, that product may not be conducive to directly offer to retail, because sometimes it's difficult to get in and out of small cap stocks. You're not sure whether this product can scale beyond a certain level, because even the fund that we have, we are probably going to stop accepting new money in it at some point in time. Right, so that's not a scalable product. So the flip side of it is, on the retail side, we have a product that does only mid caps, because mid caps can scale, can absorb that large AUM. So the difference is really the intelligence is the same, the algorithm is the same, but the slicing of the products in terms of what's conducive for a retail investor in terms of his risk profile and the scalability of the product, that's what's different across the two platforms. So the products are very different, the portfolios are very different, but the underlying tech is.
So before I go into probably the question you all get a lot about the fact that why you have AI in your name, what is the actual AI doing? Before we get into that, what you just explained sounds like obviously there is some proprietary technology that you all have built. Is this something in contrast to, let's say, the rest of the market, especially in India, people who are your peers, your competitors? What do you think is your unique, let's say, secret sauce or elements of it at least, which make for your product standing out?
Yeah, so I think first of all, as Kanika had mentioned earlier, and I want to just reiterate that we don't use any off-the-shelf product, right? Every single algorithm is written from scratch by us. So it's in the sense it's completely unique in that sense, where we don't know what else anyone else is doing, but our products we know for sure are completely unique. I think what's really different about our products, which is which stands out compared to our peers, is the fact that we are actually using machine learning, right? Usually when you find people in the investing space, they're using some static filters or what we call algorithms at the base level, right? I mean, there's algorithm, there's AI, there's ML, and there's deep learning. So we are probably in that ML section, right? Where we have built a framework. I as a human have built a framework and given the machine, okay, this is the framework. But then the machine itself is dynamically figuring out what each metric in that framework should be. I am not dictating something to the machine, where I am telling it that if you have a combination of these parameters and this is a good stock, and if you don't, then it's a bad stock. The machine is figuring out what those parameters are, what the right combination is, and it's doing so by iteratively learning from the market, right? It's doing 50 to the order of magnitude of 50 million iterations and figuring out what the right combination or the right portfolio is. So I think that's what's really unique about us. I don't know anyone else who uses this kind of an approach, right? As I told you, most people who use technology are on the technical side, right? They're trying to see some price pattern, or they're trying to see some arbitrage opportunity, something like that, right? We don't do any of that. We don't use any technicals. We don't care how a stock got 200, whether it got 200 from 10 or from 1,000. Right? What we care about is the fundamentals of the stock, and what that is in relation to the market, right? So that's, I would say, like a couple of points of differentiation.
Yeah. Primarily fundamental investing and dynamic systems that learn from each other. Yeah, in a nutshell, just to summarize.
Yes.
Awesome. On that note, I was going to take a quick break and come back and ask you to unravel that a little bit more. We'll take this one right now and come back.
Hey, it's been another great week on the IVM Podcasts Network. On Shunya One, Shiladitya speaks with Sakshi Vij, founder and CEO of Miles Cars, about her entrepreneurial journey. On Cyrus Says Cock and Bull, Cyrus, Sara, Kajol and Antariksh discuss how a passenger with no flying experience lands a plane at the Florida airport. On All Things Policy, the Takshashila folk analyze the state of abortion policy and access in India. On Naan Curry, Sadaf and Archit explore and celebrate indigenous cheese with Dr. Kurush F. Dalal. And on The Habit Coach, Ashton shares tips on how to tackle FOMO. We've got some exciting news for you. IVM Podcasts has just launched its merch, and our first line is out now. Head to the IVM Podcasts website and click on the Shop tab to check out our first collection of t-shirts. Do follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Don't forget to rate us on any platforms you're listening on. You can also check us out on YouTube. We are also doing a small listener survey to better understand how you respond to our shows and advertising on the network. We would really appreciate if you could spare a few minutes to fill it. It helps us build better shows for you. And finally, we would like to thank our sponsors this week: SBI Life Insurance, Jupiter, a digital banking app, and Capgemini. Get the future you want.
Hey, welcome back, everyone. We are obviously in conversation with Kanika and Atanuu on Upside AI, and we were, I think, just starting to hear the AI part of the story itself. So, Kanika, do you want to add to what Atanuu just said about how your tech is, let's say, a little bit more unique and different from everyone else?
Yeah. So maybe we can talk about how one of the systems works, right? So before we went on break, we talked about how we use fundamentals to invest. And how we're trying to build things that are dynamic and learn from markets, right? And that's very important because, what you should buy today is not the same as what you should buy in March 2020, for example, right?
Right.
Markets have changed, and therefore the definition of what is fundamentally good has changed, right? So usually what happens with humans is, they have a certain investing framework they work with. And that it is what it is, right? They're a value guy or a growth guy or a cement, pharma expert, something. So that's the bent with which they buy. For us, what we're saying is, as soon as you have technology, you leverage it to a point where you can be all types of experts and no expert, right? You can buy what is fundamentally good, not only on the supply side, which is actually a good company, but on the demand side also, where even the market agrees that it's a good company, and buy that intersection, right? So how that really works is, right at the beginning, we'll pull company fundamentals, P&L, balance sheet, cash flow, etc., for everything listed on the exchanges. Put it into the system, and then convert every company into ratios and numbers that any good analyst would look at to analyze a stock, right? Your growth numbers, your return ratios, debt numbers, your valuations, cash flow metrics, very normal stuff. There is no secret multiple we have, right? What's actually happening is really in step 3, which is where the algo then takes all of this and then teaches itself. So just to extend that example of why it's dynamic, at this point, what any human would do is apply an Excel filter, right? Let's just say 20p, 20% revenue growth. I'll put these two, just oversimplifying this. I'll get a short list of stocks, do a bunch of work on them, and buy another subset. So for us, we said, why this magic 20 number? Why does it work in every market? Why do they talk to each other exactly the same way? Markets keep changing. So sometimes maybe growth doesn't matter at all. Maybe valuations matter a lot. Maybe debt is more important. So that's really what ends up happening, where the AI then essentially almost starts from scratch, where it keeps going back in time, multiple time periods, and keeps testing hypotheses on what does it mean to be fundamentally good? How is it defined today? What are the right ratios? What are the right weightages for these ratios? And therefore, what are the companies to buy? So that is the millions of portfolios that it's really doing. And just live examples. So in March 2020, when we ran it, like I was talking about, before we went on break, the portfolio is very heavy in specialty chemicals. Okay. Cut to 9 months later, when we ran it in December, it had switched into metals, right? And moved from chemicals to metals over 9 months. It's not like in 9 months, a chemical stock became a bad stock. It's still a good company. Yeah. But markets have changed enough where it's now looking for value stocks. It's looking for debt on books. So the kind of parameters that are important have changed dramatically for it. And that's really where the learning part of it comes in. And then at the end of it, it'll tell you, okay, buy this list of stocks. Here's the weightages in which you should buy. And like Atanuu said, it's not automated. There is a manual process where we check everything. And then, you buy and hold, rebalance, not more than before 3 months. So we hold for much longer than most quants do.
And how much is it? How often can you do this sort of a refresh? Because practically, like you said, yes, you hold because you have to also test out whatever hypothesis shows up. But how quickly does, let's say, your model or your machine learning respond to, let's say, changes? Because I think the market weather is changing more frequently than things used to nowadays, if you call it that. So have you seen it respond fast enough, or do you take a little longer stance, like you were saying, before you take a judgment call?
So two things, right? One is the algo could trade every second. There's always a little bit more information that comes in, and it can always make a new decision, right? Now, what you're looking for is a trade-off between what are you gaining when you make a new decision versus what does it cost you to make that decision, right? Costs are your transaction costs, you're paying STT, you're paying taxes, a whole bunch of things. Right. And every time you build a product, that's what you're trying to optimize, which is net of costs. What is a good time to make a new decision? So that is one part of it. And then the second part of it is really what you said, which is weather changes every day. What is news? What is noise? Right? When in the Trump era, when Trump would tweet about aluminum, was that news or noise? Should you react to everything? Should you react to, so there is a little bit of figuring out what you should be reacting to also. Which is why for us, we're using a more time-bound approach, less event-based, at least in one of them. Maybe, I will talk about the other products we have, which do slightly different things. But idea is not to react to everything. Stay in the market as much as you can and be dynamic in terms of the decisions you make.
I'll just add one thing. I mean, what our products don't do today is we don't use any news or anything like that. Right? We only rely on objective data. Yeah. Right? Whether it is company fundamental data, which is the algorithm Kanika explained, or other algorithm that uses macro fundamental data, right? Like GDP growth, inflation, volatility. These are all objective parameters. Today, we don't use any, management commentary or, news events because of the noise versus signal issue. Right. So we stay away from that.
Okay. So that means obviously your data sources also have to be something which you let's say can rely on. And do you think that framework exists today for you guys, for all the when you built your model, you had to rely on what was already existing, right? The prior, let's say, the raw data. Do you think that is now as good as you wanted it to be, especially given Indian markets and Indian scenarios?
Yeah, actually the reason why my hypothesis, or I think it's fairly certain that why tech overtook the financial markets in the US is because investing, specifically company data, macro data, has been available in a structured form for a very long period of time. Very bankable structured data. In the US, probably from the 80s, 90s, where, service providers like Bloomberg or Thomson Reuters or these guys have been providing this data for a long period of time. And it's very reliable, very clean data, generally speaking. Of course, there are it breaks down once in a while when someone is doing willful fraud, but generally it is pretty clean. The same is true for India, probably from the early 2000s, I would say. That's from where you have really good, clean data available. And we didn't find a challenge to find bankable data sources, right? On the fundamental side, there are services in India that sort of collate that data. And on the macro side, there are government sources which provide the data from slightly later, maybe from 2010. So the source of data was not a problem. What took us a lot of time was the cleanup, right? Because the data has to be normalized. We can't just feed in raw data and expect the system to understand what it is. So we have to normalize all the data that we use. And that took us a lot of time. That was a lot of the early work that we did before we even launched the product or we started offering it to external investors. And I think that's a non-trivial process, right? It's and fortunately or unfortunately, it is specific to the algorithm and the framework that you are using, right? So it's kind of I don't know if it's a moat or whatever, but it takes time to do. It's not a trivial exercise, and it's something that you have to spend time on. Right? You can't unless you're using some technicals and only using price and volume data, right? Which is standard. If you're using fundamental data, if you're using macro data, you have to spend time to normalize it. But the data sources themselves are very reliable.
Understood.
And it's not just that, it's what is the data? And then the other thing is also sort of figuring out, cleaning it, standardizing it. And then when you build out your systems, you need to be checking, are you overfitting? Your actual models, you need to constantly test them with the data also, right? And maybe, we can go into that. Assuming you're going to ask it, but it just struck me that it's not just cleaning the data, it's also cleaning the model to make sure that, you're not just massaging it and then are getting the answers you want.
No, of course. In fact, the question I had was, everything as a company, as a product, you obviously had a direction you wanted, as or an outcome or a success criteria that you wanted for your customers and for your investors you work with, which is obviously great, which is obviously more for, wealth creation and so on. But what is your, let's say, base vision that you want to stand for? Is it long term, like how in financial companies all have a hypothesis which they promise to their investors, saying we are a wealth creation company, or we are a regular investing company, or we are for so on, we stand for this and so on and so forth. What is it that you guys have built that on, if I ask you?
Yeah, I think the primary promise really is to be unbiased and unemotional in your investing process. So rules based and dynamic. Those are the two pillars on which Upside is built. And that is what we offer our customers, which is that we will not be, I'm not a fund manager. There's nothing ad hoc that happens. And the rules will keep changing for you as markets keep changing. If we're able to do those two things for our customers well, we'll be able to do long-term wealth creation without that being the main banner on the door.
Yeah, and I just want to add something. It'll sound cliched, but I do want to say it. I think we take our roles as fiduciaries very seriously.
Yeah,
I think we are extremely conservative on ensuring that we are doing what's best for the client. Stuff like it's been in the news recently about front running and all this, and we've been talking about this for a very long time. That we make sure that there is absolutely no conflict of interest between what we are doing and what's right for the clients. Right, so we don't have any personal equity exposure in India outside of these funds. All of our money is invested through the funds, so we eat what we cook, right? Okay. And we make sure again that none of our employees, to the extent that we can control, are doing anything that's harmful to the client, right? So again, it comes from the point of view of being fiduciaries, building a 20, 25, 30-year journey of building trust with customers, right? So I think that's also a very core part of our vision.
No, very nice. Good to know that. In fact, that was going to be another segue to the question, was like, now that you've built this, obviously you spoke about the technology underlying there. It's evolving. Markets are changing. You're trying to be as dynamic as possible. So what is your, let's say, long-term outlook? Especially as a startup, I think startups by nature are, they think on short-term windows and then evolve very, very quickly. So where do you see your roadmap taking you, both from a market as well as product, if you can share?
So, market, like we were saying, long-term vision, launch our own mutual funds, manage larger pools of capital, but essentially stay in investment management and use, the systems that we talked about. And on the product side, the idea is to be a lot more broad-based. So we started with equity, small caps, moved on to large mid caps, moved on to an asset allocator, then moved on to products for retail. Now we're launching things in the US markets, for Indians to be able to invest in the US. So it's not going to be a menu where there'll be 100 of them, but just if you're going to give me 100 rupees, can I in good faith actually diversify reasonably well for you just using my products? So can I get 100% share of wallet for you without you having insane exposure to only one thing or only one sector? That's really how we're thinking about building products. So nothing overlaps. Everything we do is differentiated from each other also at a product level.
Very nice. And you said not just the Indian market, but also international markets. And that's a space which, Atanuu, I think you mentioned that is already used to using technologies like this at a very fundamental level. I mean, it's one AI against the other almost, if you think about it. So how do you aim to sort of go there with the learnings that you have so far?
Yeah. So I think, when we talk about international markets, let me be very frank, right? It's when we're talking about US market, right? That's the elephant in the room. It dominates equity and bond investing globally. Everything else is minuscule compared to what China is growing, but the US is what international markets is, at least in my view. So when you talk about the US market, I think we are not looking to compete with the hedge fund, right? We are not building products which are esoteric in any way or super, looking to maximize, do thousands of trades a minute, which is what some of these funds do, and aim to deliver outsized returns, 40-50% returns. That's not what we're trying to do. What the products that we are building today, again, we are building from the perspective of, we are very clear that we want to be a mutual fund in 3-4 years in India. So we are building a product that invests in the US from the perspective of giving Indians the opportunity to get deep US market exposure. Because what we found is that today, if as an Indian resident, you were to look at your options to invest in the US, you will find that most mutual funds are overexposed to one part of the US market, which is the tech, right? Because either they're doing ETFs, right, which mimic the S&P 500 or the Nasdaq 100, or they are directly investing in these 10-15 high-profile tech names, and which is great. I mean, tech is going to be a dominant sector going forward, but the US is a lot more than that. The US has the biggest consumer brands in the world. The US is the most innovative and the largest healthcare sector in the world. And none of the funds, I feel, are offering deep US market exposure where they're taking part in some very democratic, lucrative themes going forward, right? So we are building a product that does that, right? Where we give an investor access to these themes which they won't get today, and with the objective of delivering very, 5 to 10% alpha over the long-term US return, right? Which will be a very attractive Indian return if you add on the rupee depreciation to it. So that's our aim. So we are not trying to compete with the hedge funds. We're not building a product like that. We're not trying to do something very complicated. We're trying to build something simple, something that we can put in a mutual fund, and something that's really beneficial to a Indian customer's share of wallet.
On another point to that is, given that the Indian market or the Indian investor market, right, is something which has grown dramatically, as we know, over the past 2 years since the pandemic. I think a lot more people have gotten into equity investing in markets in general. Has that shaped your, let's say, product offerings? Have you, or when you started out, you probably anticipated a certain kind of customer in 2019, a wholly different addressable market of customers, if you think about it. So what's your change in view on that?
Yeah, so you're absolutely right, which is why we even launched small cases so early, right? Our plan was to stay within the HNI segment where you invest minimum 50 lakhs for a while, and once you have scale, then go retail. But what we realized is market is evolving so quickly. If you don't start learning today what consumers or what your retail investors want, how they behave, what are they buying, what are they selling, you'll just sort of you'll always be playing catch up, which is why for us we had to start retail much earlier. And also, of course, there is the demand side of it as well. But for us, a lot of it is making sure that we're able to stay with the market. And that is our biggest learning, which is markets are evolving way, way quicker. So just like your products, your business strategy also has to be dynamic, where you're able to, adapt and change. And similarly, that's the main reason we're doing US is because we've been getting a lot of inquiries, or people are saying, how do I get exposure? And we think it's very important for any portfolio to not just, sure, you can be in India, you can buy large, mid, small caps, you can buy thematics, blah, 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 but you're 100% India exposure. You're tied to one country, right? So you need to start diversifying at a country level also, currency level also, which is why for everyone should be looking at adding a little bit of US, whether obviously through us would be great, but if not through us, in generally, they should.
Yeah, and I just want to add that, our view is on the retail side is to experiment, but our focus remains on the PMS side. That is our bread and butter, and that's where most of our energy is focused. The retail side, as Kanika is saying, is we are observing it, right? Seeing how retail behavior evolves. And you don't know, you and I don't know, it might change dramatically if the market falls another 20-30%. Right? We've seen this when in 2007, 2008, market was at its peak. Demat accounts peaked then, and then it took them 10 years again to come back to that peak. Right? We might see that something similar repeat itself. I'm not saying it will. I don't know. Right? Maybe because the new users are much younger, maybe they have more wherewithal, they will stick by the dip, as people keep saying, and stick to it. But we have to see, right? So we are humbly just observing it, trying to participate in the market and learn, right? Our focus today is the PMS side, and 3 or 4 years from now, when we have a mutual fund, we'll go hard after retail.
That's good to know. So, and that means no thoughts on building I would say, millennial-friendly product like for investors. You definitely want to focus on folks who want long-term wealth creation.
For sure. Yeah, definitely. And we will come and say, everyday trades, every week trades. We say that's not, just because you're using AI and you shouldn't. So that's not at all philosophy.
And it's millennial friendly to build a long-term wealth product. We're trying to convince. But yeah, of course, every market goes through cycles, and we're just in a cycle where people like trading.
Yeah.
Right. All right. That's a good note. To of course conclude this very fascinating chat. I think Kanika and Tanu, for folks who were listening, whether they're millennials or not, if they do want to reach out to you, what's the best place to reach you? Do you want to share LinkedIn or Twitter or anything else you want to share where people can?
Yeah. So you can come to our website, upside.ai. You can leave us a WhatsApp. You'll get a bunch of information on there. You can follow us on Twitter. Upside_AI is our handle. We're both on it. Kanika Agarrwal, Atanuu Agarrwal. You can look for us and hear what we have to say some more outside of this.
Awesome. Thank you so much for everyone else listening to this show. Of course, wherever you're listening, do leave us a rating or a review and give us some feedback. Of course, you can reach out to the IVM Twitter handle as well, or my own at Shiladitya, and we'll be happy to chat. And if you are already investing, go check out Upside AI and, of course, all the products that this team has to offer. Thank you. Kanika, Tanu, thank you so much for the wonderful chat. We heard, I'm sure every day your models will keep evolving and you will keep giving good investment returns to all of your customers. So let's hope for the best for everyone.
Yeah. Thanks. Thank you so much for having us. We really enjoyed this chat.
Thank you.
Ladies, I'm sure you will relate to it if I say that we are constantly busy with work, studies, cooking, and what not. And amidst all of this, we often forget an important element that needs our desperate attention: finance. So here we are, bringing to you SBI Life presents A Sip of Finance, a women-exclusive podcast where we will teach you how to manage personal finances in a simple and straightforward way with your host, Priyanka Acharya, a finance expert who's been in the industry for 14 plus years. And not just in English, but in 7 more languages. So tune in every Tuesday for fresh episodes on the IVM Podcast Network and all major podcast streaming platforms.